David Kim from Gislason Hunter, a partner in the firm. Gislason Hunter is one of the more prevalent law firms in the state of Minnesota. Our family has personally worked with that firm over 4 generations today, and we're happy to have David with us. David, welcome.
I'm David Kim. I am a partner in charge of managing our business corporate practice group at Gislason Hunter law firm. Is there any certain way that the seller, the current owner of a business or assets, instead of actually a complete 100% sale, go through a transaction in a fashion where the current owner can retain certain potentially minority interest and maintain the operational aspect of control, aiming at actually staging the time of the completion of the sale so that the owner can actually take a little bit of better pricing down the road, and most importantly, create somewhat of a synergy and boost of the bottom line and partake in that value creation? I think so. Probably what comes to my mind is to differentiate between, are we talking about a potential buyer or investor in the purely financial world, or maybe a strategic partner? So depending upon who the buyer is, if it is mainly a financial play, such as private equity group, who will be aiming at certain investment goals, such as the timing of the exit and certain annual ROI during those investment time period, would be looking into more of the management control over to you as long as you can hit certain financial targets and goals. We can actually format that in terms of even a preferred share offering or issuance, somewhat of a equity play instead of a sale of the company play. In that case, probably it will be a membership interest sale agreement or stock sale agreement, along with some sort of a revised operating agreement or shareholders agreement, which lays out those type of a management control and expectation of certain financial targets and goals, and probably the even right of first refusal or call options and put options between the owner, current owner, seller versus the financial player. I think that those would be a germane topics to talk about. On the other hand, if it is going to be a strategic partner, the possibility of those type of a longer term play might be a little bit minimizing, but then still it would be somewhat of an insurance from both seller side and then buyer side in terms of the valuation of, under today's economic pressure, depression, from the seller point, is this the right price? Is this high enough? And then also from the buyer side, is this low enough, comfortable enough? Well, in order to avoid those type of continuing perpetual debate about the right pricing, one can think of arriving at some arrangement where it can be just similar to a buyout post-closing. Instead of going through that, one can actually create a pricing section. Pricing can be actually staggered through, you name it, 2-year, 3-year down the road, and in which actually the seller can have somewhat of meaningful control over that value proposition and partake in upside swing. At the same time, the buyer can actually hedge any risk of overprice. So I think that there are certain ways to structure it, Scott, so that both seller and buyer can actually find out some comfortable middle ground.
This is a very complex subject, and one that you shouldn't make on your own. Every business owner should consult with their CPA, their attorney, their lender, anyone else on their advisory team that they work with. Outside of having children and getting married, selling their business is probably one of the biggest points in a person's life, and one not to take lightly. So if we can be of help, Transworld Business Advisors in any way, be sure and contact us, tworldminnesota.com.